President, fellow guests, first of all, I'd like to give thanks for the long-standing and enduring relationship between the Republic of Ireland and the United States of America. And I would also like to give thanks for the great work that the Chamber is doing to establish even stronger relationships and to provide a forum for discussion on days like this. I'd like to give thanks as well for the US investment in Ireland and the enormous job creation and the fact that 115,000 people now work in American companies in this country. And that after having a record year last year, the IDA are forecasting another record this year for foreign direct investment in the country. On a personal note, I give thanks that my son Tim will be celebrating Thanksgiving Day in El Dorado Hills in California in about 8 hours' time with his American wife and his 2 beautiful daughters and the extended American family. This country is improving, and a lot of the improvements are due to our relationships with the IDA through and the American investment that they deliver. I think you all know the story. We're a friendly country for investors, and one of the key elements of the friendliness of the package is the 12.5% tax rate. I want to tell you once more that that's not negotiable. But it's also worth saying that I'm under no pressure anywhere in Europe or anywhere else in the world to move the 12.5% tax rate. There are various articles in various newspapers, but we don't operate on a brass plate basis in Ireland. The American companies here and the companies from elsewhere in the world who settle here, they employ thousands of people. They produce millions and hundreds of millions of goods and services, mostly for the export market. Our corporate tax regime is a low regime, but it is respectable and transparent, and it's recognized as such right around the world, and we are fully in compliance with every international standard and under no pressure whatsoever. So not only is it not a negotiable rate, nobody is asking us to do anything with it. In the European community, tax rates are a matter for sovereign governments, and this tax rate remains at 12.5% and will not be changed. That's not the total package, however. There are aspects of R&D and various other incentives as well that help to attract industry to Ireland. And in general terms, we will maintain the attractiveness of the package. We are constantly looking at competitor countries to ensure that we stay competitive in attracting foreign direct investment in. In last year's finance bill, I was able to do a few things which kept us competitive. We'll look again in this year's finance bill to see if there's any threat to us elsewhere. I think you're all aware that the United Kingdom, although pretty late into the game, is becoming increasingly attractive for foreign direct investment and is now a direct competitor of ours in many sectors. And Holland has always been a direct competitor. Outside of Europe, I suppose places like Israel and Singapore are competitors. But we watch them very closely, we monitor what they're doing, and with the assistance of the IDA, who bring many matters to our notice, we seek to remain competitive, and the policy is that we will continue to do that. The markets are very volatile. Capital is volatile. In the global markets which we now have, things can move very, very quickly. So it's important that what's being offered in Ireland is as attractive as it ever was to companies who want to set up here or to companies who want to expand here, and we'll certainly do that. We're coming towards the end of our programme now with the European Union. In terms of fulfilling the terms of the programme, it has been very successful. We have completed over 160 individual items, some of them quite significant, like recapitalising the banks, or introducing the insolvency legislation, or something I was doing yesterday, ensuring that the credit unions are viable. So the credit union bill, which is a magnum opus, went through committee stage in the House yesterday. And then there are a lot of other measures which are quite important as well, which affect the structure of the economy or make the labour market more flexible, and we have done those as well. So 160 individual items, and we haven't failed to meet any target so far in the programme. Now the bargain is that fulfil the items, they'll be reviewed every 3 months, and then we can draw down cheap funding from the IMF and the European funds. And we've done that as well, and about 80% of the money available to us at low interest rates has now been drawn down. So shortly we'll be entering the last year of the programme, and it's vital that we get back into the markets, and of course we've got back in already, but what's more important is we get back in at competitive interest rates. And the definition of that from where I stand is we have to get interest rates which are at least the equal of the official funding which we now enjoy, or alternatively lower than that. So on that test of success, we've been doing pretty well as well. We've had a good couple of weeks. The ESB raised a lot of money on the markets. Bord Gáis raised a lot of money on the markets. Bank of Ireland raised a lot of money on the markets. And Fitch, after meeting them on various occasions, have decided to move us from negative watch to stable. And that's significant in itself, but it's more significant when you think that no other European country has been moved up by any rating agency since the crisis began. So we're certainly moving in the right direction, and we would hope to reinforce the confidence of the markets by the budget we bring in next Wednesday week, which in very simple terms mean we're going to stick to our overall targets of adjustment, and that will enable us to meet the deficit deadlines that we have set for ourselves. So we're positioned to get back into the markets at low interest in 2013. And of course we will be still running deficits, and we have to fund that gap between what we raise in taxation and what we spend on services. The IMF always argue, and they're the people who are most familiar with countries in programs and exiting from programs. The way they express it is they say there's always a bit of hand-holding when a country is exiting from a program. And I've had discussions with the Troika on this issue already, and they have offered to prepare a paper on what transition measures might be put in place to assist us exiting the program. You know, if you think about it, some of them jump to mind pretty quickly. Dedicated credit lines, which we may not use at all, but would give great comfort if they're there in the background, and a variety of other backstop measures. And they have promised to provide me with that policy paper before Christmas. Now, in parallel, I have asked my officials to draw up a paper from the Irish side, and we won't put the two papers together. We'll work separately until the new year, and then we'll see where we are. But at present, we're in pretty good shape. I think as well that it's important that the NTMA keep quite an amount of cash in hand, because when you think of the kind of roller coaster ride which the world has had, and which Europe has had in particular in recent years, you can't be wondering whether you've got money for next month or not. You have to, you know, be more stable than that. So to do very simple arithmetic, we need, when we get out of difficulty at the end of next year, we'll have a deficit in round terms of about 10 billion, and we need to keep about a year and a half money in the NTMA, so that against all eventualities and against any circumstance in the market, we would be funded ahead by about a year and a half. Now, we had a repayment cliff in January of 2014. It was between 11 and 12 billion. But a lot of the interventions that the NTMA have conducted in the market were for the purposes of reducing that cliff. And we have brought it down now to about 2 billion. So at the outside, you're looking at 16 or 17 billion being held by the NTMA to provision us for 18 months to protect us against all eventualities. Now that sounds like an awful lot of money, and we'd want to get it at the right price. But the NTMA at present are holding 18 or 19 billion. So you'd be rolling that and keeping that going. Actually, when you look at the Irish debt, a lot of the anxiety is due to accounting rather than the actuality, even though we have a huge debt, because the cash on hand held by the NTMA cannot be offset against the debt. So while our debt will peak at 120% of GDP, if the 20 billion or so which the NTMA hold, if we could get a credit for that, the real position would be about 104, 105. That's not to say that the debt isn't too high, and that's not to say that we're not working very actively to make the Irish debt position more sustainable. But I just want to give you a bit of context, because I know as key decision makers right across our economy, you need to know what we're thinking in terms of exiting from the programme and running our own affairs again, funding ourselves on the markets at reasonable interest rates, and I know you appreciate the knock-on effects that that can have for the funding of private industry in any economy. Again, I'd like to thank all the American companies that give so much employment and provide so much economic activity in this country. It's amazing when you list the companies that are here right across the sectors. You know them yourselves, so I'm not going to recite the list here today. We have a number of things to look forward to. Next year, the EU presidency. Ireland will be conducting that and will keep us pretty busy. It effectively means that people like myself will have to chair the meetings. And you know yourself, when you're chairing the meeting, it's not enough to know the bit that interests yourself. You have to do your homework on other people's issues as well. So that'll keep us pretty busy for the first half of the year. But it gives us an opportunity as well to show that, you know, in normal times, we're a pretty competent country that can do things and can work to targets and achieve results. And that's the way we will approach the presidency. The big project is the European Banking Union. And the European Banking Union has three constituent parts. First of all, we must have banking supervision right across the 27. And that will be conducted by the European Central Bank. But of course, they will decentralize to local regulators, part of it. So what you need to think of is the legal competence in Frankfurt for regulating the banking system right across Europe. But then a rule book which will be applicable and implemented on the decentralization basis in many instances by the local regulators, and various manuals and protocols then to do the actual detail. There's no point in having a European-wide banking supervision if it's not as good as what the best countries in Europe have at present. So we need added value, but we need consistency as well, so that wherever we are in Europe, the same regulatory regime will apply. So that's the first step, and the legal framework for that should be ready in the first week of January, and then it's a matter for the European Central Bank to bed it in and to apply it. They will directly supervise 20 or 30 systemic international banks, but they will delegate to local regulators on an agreed rule book how regulation should be done. And you know, there are 6,000 banks or so across the European Union. So it's a pretty big task, and quite clearly logistically it couldn't all be done from the centre with a core of people from Frankfurt flying in and out of European capitals every morning. The second part of the banking union will be a resolution system. So if banks break down, if banks become insolvent, that rather than being resolved by the sovereign state in which they operate, there will have to be a European system of resolving the difficulty. Now, in the first instance, it will still remain within the competence of the sovereign, but then it will become a European responsibility. And similarly, with insuring deposits across the system, there will be a movement from sovereign government responsibility to European-wide responsibility. So it's a very big project, and we will be at the coalface of the first steps on supervision in the first 6 months of next year in achieving that. The other interesting thing that's happening next year is the gathering, and we hope that a lot of people will visit Ireland who have a connection with Ireland. Various communities are organising visits of immigrants and people who immigrated and who are the descendants of immigrants. So I hope that works out as well. Finally, I give thanks today to the close bonds of friendship between the United States and Ireland, and I look forward to the continuing support of the American Chamber in 2013 and beyond. Thank you very much.